So you're looking to sell a piece of real estate and you're worried about capital gains tax. Well, in this video, I'm going to show you how you never have to pay capital gains tax ever again. All right, let's get going. In this video, I'm going to show you the #1 method that everyone in the real estate space that knows what you're doing is using to avoid capital gains taxes when selling any kind of real estate. Doesn't matter if it's houses, land, or commercial real estate. It works. I've done it many times. All my friends are doing it. And if you have not done it, then watch this video, because at the end of this video, you will know exactly how you will never have to pay taxes ever again when you sell a piece of real estate. So the first message here is that while this video is about land, there's really no difference in how to avoid capital gains taxes between land and houses. Because here's the thing, every house is built on land, and what you really are selling when you're selling is the land. So as I said, just in one case you sell an empty piece of land, in the other case you sell a piece of land with a house on it. So from a tax point of view, and particularly a capital gains point of view, there's absolutely no difference between selling a piece of land and selling a house. So in this example, I'm going to bring examples about houses or land. It doesn't really matter. It's all the exact same thing. So with that said, let's go and let me explain how capital gains avoidance works. Okay. So there's two ways that I'm actually going to cover. The first way is really the less known way, but the way that almost everyone can use when you sell your own primary residence. And that is very simply, it's an exemption in the tax code that basically says that when you sell your own single family residence, then if you're single, you get to take the first $250,000 off capital gains and not pay taxes on it. And if you're married, you can actually double that to $500,000. So let's use an example. So let's say you buy a house for $500,000 and you hold it at least 2 years. And let's say it's this either a hot market or you just held it for more than that. You held it for 10 years. And after that, you say like, you know what, it's time to, the kids are born, we have 2, 3 kids now, we need a bigger house. You move, but this area is becoming the hot area of the city, and prices have doubled in the area. So you now go take that house and sell it for $1 million. Now it's husband and wife, you're married to each other, and the house is owned by both of you. And now what happens is when you sell it for $1 million, technically you had a $500,000 gain. So technically you would have to pay capital gains taxes of be up to 25%. It's a sliding scale, but up to 25% on that money. Well, the reality though is because it was your primary residence, you can apply that exemption. And as a matter of fact, therefore, you pay 0 taxes. You just let your CPA know that this was your personal residence, that you bought it for $500,000, you sold it for $1 million. You show them the closing documents of both things. So it's important to keep your closing documents when you buy a piece of real estate, because it's used to figure out what your profit was when you sell it. And therefore, you now have $500,000 in the bank that you don't have to pay taxes on. And again, if you were to be single, cut that number in half, then it would be $250,000. In that case, however, on the other $250,000, you would have to pay taxes. Now, if that is the situation, let's go right into the second way of how you avoid that situation. So let's say you have that same house and you're not married, you're single. You bought that house for $500,000, now it's worth $1 million, and you go sell it. You know that you get the exemption for yourself, but the other $250,000 you now have to pay taxes on. Now let's say at a capital gains rate of 20%, that is actually $50,000. So who would like to not pay $50,000? Well, I would like to not pay that. You probably won't like to pay that. So therefore, here is what you can do. And what you do is what's called a 1031 exchange. By the way, you can do that for your house, but you can also do that for any kind of an investment property. A 1031 exchange very simply says, and obviously it's tax code 1031, that's why it's called 1031 exchange. It simply says that you can take a property, and when you sell it, you can declare that you want to do a 1031 exchange, first of all, and then you have to bring in what's called a 1031 exchange custodian. So it's a third-party company. They come in, and what they do is they have you sign you some paperwork, and then when you sell the property, they get the money. So if you bought this property for $500,000 and selling for $1 million, and let's say there's a $400,000 mortgage still on there, the bank gets $400,000, and the difference between the sale price and the balance of the loan, in this case $600,000, $600,000 goes to the 1031 exchange custodian. You do not touch a dollar of that money. All right. Also, before closing, they'll send you a document that allows you to already select up to 3 different what's called exchange properties. Now, if you don't have them by the time you sell the house, that's okay, because you have a total of 45 days to select up to 3 different candidates that you can replace that property with. So let's say you have set your eyes on $1 million instead of buying a new house. You say, like, you know what, I'm going to use that $600,000 and I'm going to go and buy a $2 million commercial property with that. And instead, I'm just going to rent. It's okay, whichever way you want to do this. So you want to do this, so you go look for $2 million commercial properties and you find 3 of them. So what you do is you fill out the address of those 3 and the estimated purchase price, and you submit that again to the custodian. Now, the moment you have done that, you have a total of, from the moment that your property sold, you have 45 days to select that, and then you have a total of 180 days, again, from the moment that you sold your property, 180 days to actually close on at least one of those 3. So what happens next is you go make an offer, you get your offer accepted, and when you get it accepted on one of these 3, then you open escrow, you get ready to get financing, and once that is all set, at the very last moment in the last few days when the title company said, okay, now we need all the money, then the title company will ask the custodian, the 1031 exchange custodian, to actually send those $600,000 in to the title company. Again, you still don't touch that money. And so now the title company has all the $600,000. They use that as a down payment. You get a $1.4 million loan for the $2 million purchase, and everything goes. You close on the deal. You now own that commercial property with a $600,000 down payment, with a $1.4 million loan. I don't know, perhaps that thing spits out $15,000 a month in cash flow, $180,000 a year in cash flow, and you can own that for as long as you want. And when you're ready to sell that property, you just repeat the exact process. You just basically put it up for sale, you find a buyer, you let the buyer know, you let the title company know that you're planning to do a 1031 exchange. You bring in, if you had a good experience, that same 1031 exchange custodian in again. They send the paperwork to everyone involved. Then when that property sells, again, let's say you sell that property for $3 million. Now, you had a $1.4 million loan. Let's say that one is only $1.3 million. You paid it down by $100,000. So you have $700,000 in equity plus the $1 million in value appreciation. So you have $1.7 million in here. But the biggest problem is that if you would sell it at $3 million and you bought it at $2 million, you now had a $1 million gain in this situation. So you would have to again pay $200,000 to $250,000 in taxes. But by repeating the process, now that the custodian gets $1.7 million sent to them, you go find a $5 million property or $6 million property that you can roll that over in. You find it, you exchange into it, and you do that again and again and again and again. The only downside of that is that you never get to touch your actual cash. But even there is a way around that, because eventually down the road, you could refinance that property. And when you refinance that property, let's say if it's worth the property is $3 million, you refinance it, and you refinance it at $2 million, guess what? You pay off your $1.4 million loan, you get your $600,000 back tax-free. So there's always a way to eventually get your hands on your cash. But that is the subject to yet another video. All right, so in the examples I just used, I used house and then commercial real estate examples, but again, you could do the exact same thing on a piece of land that you then exchange into a larger piece of land, or that you exchange into a house, or a house that you exchange into a piece of land, or a piece of land that you exchange into a commercial piece of land. So whether I used houses or commercial doesn't matter. It's all the exact same thing. There's no difference whatsoever. All right, so with that said, once you understand the rules, you can apply it to any real estate. All right, with that said, there's many more videos where this came from. Make sure you subscribe right now and you share it with your friends. All right, see you in the next video.